investor chooses different assets to invest in, they need to understand the different risk and return that comes with each asset class. Equities, specifically individual stocks, are often looked at as a higher risk investment but offer a higher return given the risk. For example, many people wish they would have bought Amazon when they first were available to trade in the late 90s. Although Amazon has performed incredibly well, arguably one of the best investments in the 21st century, many people don't know that Amazon at one point was down nearly 90% in the early years. Would you have been able to stomach that risk? You would have been rewarded with immense returns. On the other hand, bonds are looked at as a safer investment, giving investors a fixed income. On a year-to-year basis, bonds typically return between 4 and 6%, sometimes lower in years that have higher inflation. These asset classes play an important role in investors' asset allocation and how one's asset allocation changes throughout one's working career, near retirement, and within retirement. Generally, a younger investor given their longer time horizon would be invested more aggressively, which would have an asset allocation favoring majority equities. This could look like an allocation of 100% stocks, 90% stocks, or 80% stocks to bonds. As an investor is nearing retirement and is getting ready to rely on their investments, an allocation may start to look more balanced, like 60% stocks or even a 50-50 stock to bond portfolio. They are still able to have the appreciation of equities, but are able to stabilize a portfolio and protect from the downside with bonds. In retirement, an asset allocation may look more conservative, with the portfolio being mainly allocated to bonds. An allocation may look like 30-70 stock to bonds, 20-80 stock to bonds, or even 100% invested to bonds with a focus of capital preservation instead of growth. Asset allocation is an important part of portfolio construction in all stages of one's investing career.